Hey, if you are watching the replay here, you can fast forward to the disclaimers, the disclosures, whatever you want to call them. We're waiting for the live studio audience to come in, so it'll be just a couple of minutes. Let's see, we got hey, I'm back. Okay, it's been a couple of weeks, and I had a nice little break to the point where I'm actually looking forward to this. No guarantees I'll be here every week, right? But we're here this week, so let's have a discussion. AI, my man, AI, and ladies, of course. I can't forget the ladies. I actually like you the most. Sorry, guys. 99% of this audience, according to the YouTube stats, are males, but you females out there actually understand this stuff better. You take more better notes and all that stuff as a whole. The guys are you guys, man, you guys are a pain in the ass, you know. But I love all y'all, and we are going to talk stocks. Let's see what we got for the live studio audience and confirm we got audio and video. Yeah, we do. We got audio and video. Okay. That's it. I mean, we don't have a lot of people on the live as of right now. Maybe because I was, gone for a couple weeks. Maybe because people don't like the new show. Too bad for them. But for you, it's Friday. It's Money Mark and it's Stock Talk Live. Here are the disclaimers on the page right now. If you watch this show, you acknowledge that you have read or had somebody read to you these disclaimers and are okay with them as you move forward with this show. All right. So we're going to get right back in. We're going to get right into it. For those who hit the subscribe and notification bell, you got notified that I'm live. So you know I'm live. So you're here right now. And so we're not waiting for anybody else. Let's get into it. No BS. Let's see. We got to pull out of this and go into this. We're going to go real quick through the macro because we got much more important things to talk about than the macro. But first of all, we're in basically close to neutral territory. The thing to take to heart with this indicator here is it's been very good at the extremes. Okay, when you get above 75, right? This line here is considered extreme greed. That's a great time to make sure you are following all the rules of taking profits, both on a valuation basis and a technical basis. I'll show you examples of that today. You know how to look at a chart. In fact, we can just skip to it. This was a perfect example that we've seen. We're going to talk about this one a little bit today as well. I've shied away from, giving recommendations or anything like that. This is, you guys have to figure it out for yourselves. We've got, the Breakout Investors has their own WhatsApp group. I've told y'all how to get in there so you can get in there and have your discussions and figure out for yourself if you want to be in these stocks or not. Personally, I don't care because I have a track record before I was ever an internet personality of making 40% a year. Since I started doing these things on the internet, I've made 40% a year. It doesn't matter. I make 40% a year no matter what. Okay. The question is whether you want to learn the right way to do things or not, because there's 10,000 clowns out there, and not just clowns, there's bad actors, and they're all out for themselves. So for you to listen to any of them instead of trusting and empowering yourself to understand these things so that you are making a good decision for you instead of making a bad decision that somebody else talked you into, well, I can't help you with that if you take that route. So anyways, let's zoom in on this OPTX chart just to show you an example of what I was talking about. So you see here, you've got these outer lines here, which to me, these are technical. You notice they're not red and green. So those of you who have followed me for a long time know and these are my personal charts, right? I'm not telling you what to do, but you know that when I show my personal charts, red and green lines represent fundamental tops and bottoms based on what I believe a stock should be worth if they are operating on 0 cylinders or all cylinders, okay? Now on the path to getting from the low line to the high line, right? The implication is that if I'm buying a stock, me personally, I personally believe that the company will move more towards being operating on all cylinders at some point in the future, and therefore the stock will rise dramatically to reflect that. Okay? On the path to going from the lower end of the fundamental range to the high end of the fundamental range, there's a lot of technical analysis. There's day traders out there. There's a lot of algorithmic trading that takes place. And so technical analysis has become very dominant in this society of stock market investment, right? So even if you are a fundamentalist, which you should be, that is the prevailing method, right? Warren Buffett became the richest man on earth because he understood fundamentals. Ultimately, what a stock is worth determines whether you should buy it or not. In crypto, it's different because it's very hard to determine what a crypto is worth. But in stocks, it is much easier. Okay? Real estate's very easy, right? You can figure out how much can I rent this house for? If I buy this house, what will the mortgage be? And then you can just use common sense. Well, shoot, if my mortgage is going to be $2,000, but the rents in the neighborhood are $500, I shouldn't buy this house because I'm going to be paying $2,000 a month to get $500 back. That's easy. Stocks are a little more complex. Crypto is even more complex and in some cases impossible because there's really nothing behind them. You want to be dealing with things that you understand the value of. Okay? So, I don't have red and green lines for OPTX, but these are the technical lines that I've been using as guidance. And what you can see here, as I've shown in the past, is looking as this thing moved up, right? A very definable channel. You can see there was this create a parallel line. It was moving up through this channel, right? You could buy on spikes, sell on buy on dips, sell on spikes. Get it right, Mark. Buy low, sell high, right? And that was very good until it wasn't. But here you get a winner, out, winner, out, winner. And you get back in, and you get another winner, you get out, and it comes down here, you buy back again, and it doesn't work out. Okay, cool. Why is it cool? Well, technical analysts, and you can see what happens here, day traders and the like, they see the breakdown. It tests the former support level, right? Look, I'll break it down. A lot of you know this already, but just for everybody to understand, this line right here is the support level. This is the floor, right? It was bouncing to the ceiling, dropping to the floor, bouncing to the ceiling, dropping to the floor, bouncing to the ceiling, dropping to the floor. And if you break through the floor, then the floor becomes the new ceiling, potentially. And so what ends up happening is the stock oftentimes will test this level again, which it did, and the day traders a lot of times will use that to get out. If there's not enough investors to push the stock back into the channel where this becomes the floor again, it becomes the ceiling, it rejects, and this is what the stock has done. From a purely technical perspective, most investors out there who do technicals or fundamentals, most of them do technicals. Very few do fundamentals. Oh yeah, you might say you understand PE ratios, but PE ratios is not fundamentals. Okay, it takes years and years and years to understand the fundamental value of a company and whether or not you should buy it at a certain level. So for me, when I get involved with a stock like this, right, it's presumed that I like the company from a fundamental perspective. I'm not making a comment on OPTX or what I think it's worth, but what I'm telling you is if I own the stock, it's because I believe that I am getting a bargain on the price of the stock. Then, separately, if I'm playing the stock from a trading perspective, if and when it stops working, I don't have to worry about that because I feel like I'm getting a bargain on the stock. So if it goes lower, that just makes me want to own more. That's a Warren Buffett principle. And this is how you win with the combination of fundamental and technical analysis, putting them together. You get to do what all the investors out there, most of the investors out there are doing, technical analysis, versus what the very few, the richest people in the world are doing, which is the fundamental analysis. And when you put them together, boom, you can make way more money than either one can using just fundamentals or just technicals. All right. So there you go with that. Let's go back to where we're talking about here. Very quickly, the Treasury yields are on the lower end of the range that it's been recently. The fear greed index, I mean, we're in good shape here. All right, we're in pretty good shape. I'm going to go to my notes for a second because, oh yeah, let's check the GDP now for a sec. Because what I think we're going to see here is another positive number on the GDP now. They changed this a little bit. But the GDP now estimate is currently 3% GDP growth. I believe this says for Q4. The blue chip consensus has moved up. Okay, because the blue chip consensus, the last time we spoke, the bottom of this chart was under zero. And now everybody is above zero. Almost everybody is above 1. The average is at 2. The high end is at 3. And GDP now is at 3. That's the Atlanta Fed. And the Atlanta Fed, typically, in my watching of this measure, this right here is usually more right than this right here. So we have a healthy economy. It's definitely not a recession below zero. We're at 3%. The data that I've seen since the last time we spoke showed that there is a downward revision in the job additions that occurred in the economy last year. So we have GDP that's strong. And what you want to look at, right, is if you're dividing the complete GDP of the country by how many people are actually contributing to it, when this number gets lower, then that means that the average GDP contribution per person is increased. And that's exactly how you should think about this. You don't have to understand what I said to understand that the amount of GDP, the amount of production coming out of each worker in this economy, the United States of America, has been increasing. And what is said is that that increase is presumed to be because of productivity. And right now, the key driver, the consensus is that the key driver of productivity is AI. Okay, now we finally got to the part, took 13 minutes to get to the part to show you guys care about AI. Let's talk about AI and what's going on there. Because we have a strong economy. And even though, I've been warning about this yellow alert for a long time, and finally the IWM has reached yellow alert territory. But if you look at the Qs, right, let's zoom in a little bit. Since we hit the yellow alert territory by breaching the red line, we've gone nowhere. This was in September, October, November, December, January, February, 6 months of basically going nowhere, very slightly up on the Qs. S&P 500, there we go. There's the breach of the red line there. Again, gone almost nowhere, just kind of hugging that red line. The IWM from that level was the only index, and I told you this was the only index that wasn't at yellow alert territory yet. But be careful, because if the NASDAQ crashes or the S&P crashes, that it's going to take the Russell with it. And as you can see, the NASDAQ didn't crash, it flatlined. The S&P didn't crash, it flatlined. And what happened was people were like, I can't invest in the Magnificent Seven, they're too expensive. I can't invest in the S&P, it's too expensive. What's left? The small caps start getting all the action. And boom, next thing you know, now we're at yellow alert for the small caps, and they have now flatlined since reaching that level. Okay? This is why you got to be careful. Now, here's the thing you got to keep in mind. If we go back in time, there is an argument that says that, and maybe I'll use the S&P for this, okay? Because that will probably depict it better. Yeah, I will. Boom. Is that the Dow chart that I just showed you went back to 1915 and showed, in fact, let me show that real quick so you see it, that we had a breach of the red line and the market kept going up. That's called a melt up. That's aka a bubble. That was the 1920s bubble, and it ends badly. Bubbles burst. Okay? Now, we go to the S&P chart, and what you'll see is the only other time since 1915 that we've gone materially above the red line was in the late 90s, the internet bubble. Now, why did that happen? Very simply, I was there. I was an analyst in the technology sector. Technology, the laptop, Dell, Gateway, everybody getting computers in their workplace and at their home. I remember getting one for Christmas, etc., etc. Then all of a sudden your productivity, there's that word again, goes through the roof. And when your productivity goes through the roof, GDP tends to follow, and it's good for corporations. And what's good for corporations is good for stocks in general, all else being equal, right? So now we have a similar situation now where AI is, let's use the word threatening, to create a tailwind of productivity that could potentially mirror what happened in the late 90s. I can't say if it's going to happen or not, but that is the counterbalance to the yellow alert. Right? So on one hand, valuations are historically high, but on the other hand, AI is enabling productivity gains. And which one wins? Honestly, I think only God knows. There's many people giving opinions, but I haven't seen anybody give a really strong argument in terms of how this plays out from a valuation of stocks perspective. So you have to continue to be careful and go for the low-hanging fruit in the stock market. You guys might have thought, there's a lot of you who might have said, well, Meta's the low-hanging fruit. I'll buy that. That's safe. Well, not really, because Meta Meta, I'm sorry, I meant to put NVIDIA. We'll put that one up in a second. But Meta down 17% from its high. NVIDIA down 11% from its high. And never mind Oracle, smoked. Okay? And this is where we get to the part of the conversation where I show you some crazy charts. Okay?
Unknown caller.
Oh. Hold on a second. Oops. I'm going to need some help here. There's something going on right now at my house. I just need 30 seconds to get my wife to take care of this. Let's see. Julie, check your texts. All right, sorry about that, folks. Let's get back to it. Let's see all right, so the companies that are getting smoked out there, it's really crazy what's happening because of AI. So since the last time we spoke, there has been, obviously everybody knows about software, right? Oracle getting smoked. Salesforce.com getting smoked, right? ServiceNow getting smoked. All of these software companies getting smoked. Why? Because what I've been telling you for the last 2 years, AI is not a bubble. Don't be surprised with what AI does next. Don't be surprised if you, in the future, not too distant future, so 2 years ago I predicted that there'd be an Avengers movie made completely with AI in 10 years. We're 2 years into that prediction, and already I'm going to show you something here.
Caller.
Let me answer this real quick. Hey, Pablo?
Mark, what's up?
Yeah, my wife is going to call you.
Okay.
I'm in a meeting right now, but she's going to let you in.
All right. I just want to talk to you.
Okay. I have to go, but she will call you.
All right.
Thank you. All right. Sorry about that, folks. It's actually somebody who was supposed to be here to fix one of our appliances before noon, and obviously is a little bit late. So it interrupts the show. Sorry, we want the appliances to be fixed. Anyways, okay. So you saw the software companies getting smoked because of AI, what AI can do. We're going to talk about the movie aspect and my prediction very shortly. But first of all, since the last time we spoke, right, a number of industries have gotten crushed as a result of what's going on with AI. Fears of what AI is going to do to these industries. And you might be surprised, okay? Let's look at TripAdvisor, the travel industry. Why would the travel industry get hurt by AI? Well, because AI can disintermediate travel agents, okay? I can tell you that I went to the Super Bowl this year and I wanted to get tickets at the lowest possible price. I used AI to help me do that, and AI nailed it. I got great tickets at the lowest possible price without risking not finding a ticket on game day. Right? That's a big risk. The last time I actually tried to go to the Super Bowl 11 years ago, and I was like, oh, I'll just show up at the stadium and I'll get the lowest possible price from somebody desperate to sell their ticket. Well, guess what? There were no tickets left and ticket prices went through the roof, $7,500 to get in the door, and I didn't go to the Super Bowl. So this time I'm like, okay, let me not take that risk. Let me get the lowest possible price without taking that risk. I nailed it because of AI. AI is going to also nail it with regard to booking trips, tell you what airline to buy on, what hotel to book, and what days to book them to get the best price possible. Okay? Well, if you have an AI agent, and by the way, if you don't know that AI agents are the latest big news, that's February's big news in AI is AI agents and software development. We are soon going to program an AI agent to go out and find the best prices for flights and hotels, and it's going to come back and just tell you, which I'm going to love because I hate spending hours trying to find the perfect flight and the perfect hotel. AI will do that work for you. So all of a sudden, a TripAdvisor becomes unnecessary, right? Because an AI agent's will not only find that stuff for you and say, what do you think? And I'll be like, this looks great. Go ahead and book it. And it will go ahead and book the hotel through the hotel and book the flight through the airline, because what does it need TripAdvisor for? It won't. Okay? So you see these stocks getting smoked. I mean, look at this thing. It's terrible. Also, Morgan Stanley. Why? And like, we got to zoom in for this to see how it's gotten smoked recently. Boom. Okay? Also, not just Morgan Stanley, but is it Thomson Reuters? We'll go to that one in a second. But Morgan Stanley, oh yeah, Charles Schwab. That's what I was looking at. Charles Schwab. Why Morgan? Look at that. Why Morgan Stanley and Charles Schwab getting smoked? Well, simple. Because these companies have huge asset management groups, wealth management groups, advisors. I have a wealth management advisor at UBS. He does a great job. But AI is going to be able to do that job in the future. Okay? And it's actually able to do some of that job now. So why should I be paying an advisor to do something that AI can do for free? Right? It gets you thinking about these things. And even if I keep my advisor, which I probably will, if 10% of people get rid of their advisors, that means revenue goes down 10%. That's major. Because if these companies are growing 5% a year and all of a sudden 10% of the customers go away, instead of reporting 5% growth, they report negative 5% growth, their stocks are going to get smoked. And it's being preempted right now. This is the preemptive strike on these companies being afraid of what's going to happen next. Who else? Thomson Reuters, who provides financial information services. Destroyed. I mean, this one, look at that. Okay? 219 to 83 in 7 months. 61% for a company that before this has been an absolute monster. An absolutely great company where you just make money. It's never had a drop like this. Closest thing to it was the financial crisis. We're in a great economy and this thing has gotten smoked in 7 months because of the fear that AI is going to wipe out the need for Services like this. CBRE, commercial real estate. What does that have to do with AI? Well, boom, obviously something, right? Trucking and logistics, C.R. Robinson, crushed. Coming back, right? But the initial reaction to the fears that AI might cause a problem for these industries is making them very dangerous. And then the last one I'll give you, insurance brokers. I haven't even seen this chart yet. Not surprised. Okay? Because any kind of broker, any kind of intermediary can get wiped out by an AI agent, because why do you need an intermediary if your AI agent will go and do the work for you? AI is not a bubble. There are stocks involved with AI that got into bubble territory, and probably still are some, but AI itself is not a bubble. It continues to surprise even me. I've been a technology analyst since the early 90s, and I continue to be surprised every month by the new capabilities we see in AI, and the latest of which, look at this, okay? Let's run.
That has Hollywood freaking out. Two of the biggest stars in the world, Brad Pitt and Tom Cruise, apparently duking it out on the roof of a skyscraper. But it's completely fake, digitally created with AI technology. And while it may be fun to watch, it's sending shockwaves through Hollywood.
If you haven't seen it, look it up. I'm not going to keep playing it. The rest of this, Tom Cruise and Brad Pitt AI, as you saw, right? I mean, look at this.
Today over this epic fight scene between Brad Pitt and Tom Cruise.
I mean, it looks pretty good, right? It looks like Brad Pitt. It looks like Tom Cruise. It looks like these are. And from what I understand now, by the way, huge copyright infringement, right? Because the likeness of Tom Cruise and Brad Pitt, like Tom Cruise and Brad Pitt should get paid for this. Well, what happens when you deal with a country like China that doesn't seem to care so much about copyright infringement as the United States does? No offense to Chinese people or the country of China, but this is just the way it is that you've got AI models out there, in particular open source models, you got DeepSeek, etc., and these things get created, okay? What happens if a Chinese company decides with a Chinese AI model to make a whole movie and release it out into the world? Who's going to stop it? Who's going to block it? Who's going to sue them? Right? So this is sending shockwaves through Hollywood. I didn't even think about this, okay? Because I was thinking, well, this is great for Tom Cruise because he'll never die, right? He can continue to do movies even after he's dead, right? Because boom, you got his likeness and you go. But I thought the beneficiaries would be the movie studios in the United States, but now we've got a little wrinkle in the cream where they're going to have to defend their intellectual property, because right here it's Tom Cruise and Brad Pitt, but what's to stop it from being Thor and the Hulk, Batman and Robin, right? And boom, what you saw right here is clear sign that when I said we might have a full-length Avengers movie within 10 years, seems like you might want to take the under on that, folks. By the way, if you want to stay up on this, right, and understand what's going on, there's a few things that I recommend. And one thing, actually, above all else, the All In podcast. This is not an advertisement. It's not a sponsorship. This is something that I listen to every week because it is very informative to me to help me understand, okay, what is going on in the world of AI. And so that's one thing. Separately, that's all you need to know. That's all I'm going to give you this week. There's actually an all, you know what it is? Let me find the podcast now. The name of the podcast is, here it is, the AI Daily Brief. Okay, so you can look up the AI Daily Brief podcast. Boom. All right. This is great. All right, keeps you up on what's going on. So All right, AI, all in podcast, boom. All right, and we just settled the matter with the appliances. So onward we go. By the way, this was, here you have an AI company. This is an AI driven kind of startup. Next generation automated bookings capabilities. Okay. Let me settle this. I'll handle it later, period. I'll handle it later. Okay. Boom. So if you're having it, if it's so easy to develop software, right? New software, then you can start a new business. And for companies that don't have large barriers to entry, you're screwed. You're screwed. These companies can make the software so quickly, market themselves, and you're in trouble. Okay, so we have to be very careful about the companies that we invest in to make sure that they are not at that kind of risk. All right, that takes care of all that. Good. Oh, by the way, so for those of you interested in Curiosity Stream, hasn't been doing well, right? Like a lot of stocks, especially AI related stocks, hasn't been doing well. I continue to own it in good size personally. I'm not going anywhere. Obviously, look at the disclosures, the disclaimers. I can change my mind at any time, blah, blah, blah. But I have no plans to move my position. I still feel very good about it. And this right here, Media in the Machine, Substack, had an interview with the CEO of Curiosity Stream. Okay, great conversation. Not only insight into the company itself, Curiosity Stream, but also the industry of AI and how video is playing a part in the revolution. So be sure to check that out. Again, it's not an advertisement. This is something I listened to of my own volition because I felt like it was a good use of time. Now, so what do we want to look at? This is a defense company we've talked about before. Rob Mock from the WhatsApp community made this pick, and also Robert Abbott putting information out there. And defense, okay? No matter what happens in society right now, defense stocks should be really good. If you make things, okay, AI is not going to disintermediate you. All right. AI can only help. You'll be able to use AI in your factories to, inject more efficiency into your manufacturing processes. Does that allow some competitor to come in and use AI to compete against you? Yeah, but once the level is set, right, it's not like somebody's going to use AI to change the dynamics of your business. You still have to get a factory, build out the machinery, get the employees, blah, 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 which those companies already have. Okay? Companies like OPTX and TPCS already have that stuff, along with something that's very important, the clearance of the United States of America. Very difficult to replicate, and AI is not going to help with that. So defense is great. If we have a recession, right? Defense is an area that's going to stay up no matter what, because in a recession, what happens? GDP goes down, and the U.S. government provides stimulus. They spend money to support the economy that is weak, right? And one of the ways they do that is to at least continue to spend money on defense. They're not going to cut back. That's going to make the recession worse. If anything, they will spend more to help the recession not be as severe. So defense is good. I will tell you, consumer staples is usually the safe haven, and that's where money managers, there's people out there, I know a lot of them, that manage billions of dollars, right, for your ETFs, for your mutual funds, for your hedge funds, and they don't have the luxury of going into cash, buying USFR and just waiting, for something great to appear on their radar screen. No, most of these entities, ETFs, mutual funds, hedge funds, have to be close to 100% invested. So they have to be invested in something, Okay? And so if you have to be invested in something, but you don't feel safe, right? These guys aren't dumb. You're going to go to the safest entities. And what ends up happening is you see companies like Walmart. Let me back up the, boom. Look at that. 2025 performance. Look at that 2024 performance. We have a 2-year performance of 140% for Walmart. Like, it's even hard. I'm looking at it right now and it's hard to imagine a company as big as Walmart going up 140% in 2 years. Okay? And yet there it is. Why? Because people feel like, well, Walmart's the one safe place for me. And if you go back, look at this chart going way back, you can see, right? We haven't seen this kind of hockey stick in Walmart since the late 90s. I personally am not buying Walmart at these levels because it's a very elevated PE ratio. You are paying for safety, and increasingly money managers have piled into Walmart for that safety. They're paying a premium for it, and I'm not chasing that premium. I did just fine in 2024 and 2025. My stocks did better than Walmart has done over those 2 years, so I didn't need to own Walmart. And now that I'm saying, well, we're in yellow alert now, I need to be safer with my money. Can I find a safe place for it? Well, Walmart's already elevated in price, so I don't want that now. Maybe if it was down here, right, that would make more sense. Now, Amazon, maybe. Okay, Amazon's a name that's very intriguing to me. I haven't had time to, sit down, make a determination, but I am predisposed if I'm going to put some of my USFR, my money market money into something. Amazon's one of the places that I might put it because they have the technological advantage. They're a consumer staple, right? Everybody uses Amazon. Nobody's going to stop, right? In a recession, yeah, maybe it slows down a little bit because, the things that people don't need, they might stop buying from Amazon. But, I get all my groceries from Amazon. We have to eat, right? You have to eat, you have to shower, you got to buy soap, things like that. And we do that all through Amazon. So these are the kinds of names that you have to look for, but you have to make sure that you're paying a fair price. And that's becoming increasingly difficult to find because all of that big money has already been flowing out of the risky stuff and into the safe stuff, right? You see the Mag 7 performance. These multi-trillion-dollar companies, as people started to sell their Nvidia stock at these high levels because it doesn't feel safe anymore, that's a lot of money. Those are huge positions. And to take money from Nvidia and invest it in something else, you probably need several something else's to put that money in because it's so much money, right? So to have the Mag 7 have money flowing out of them, it's actually floating the boat of the remaining S&P 493. And that's what's been happening here. And so that's where you see the S&P just churning, right? But I don't know if there's an ETF called the S&P, let me see. It'd be interesting if I could find the S&P 493. No, if that was an ETF, you would see it looking a lot stronger than this because the Magnificent Seven has been dragging this chart down. Okay. All right. So that takes care of that. Let's go other AI news. So okay. So there's that. There's OPTX. By the way, this is very interesting. So this is just news. I'll give you my opinion on recent news. You had this report that came out, but you also had a short report that came out. When I read the short report, I was like, oh, another one of the 10,000 clowns. It didn't say anything that was new. It didn't demonstrate an understanding of the situation or the story of this company as it has been presented by Rob Mock. But then there was something else that was really funny that happened, which was a character on the internet called Billy Billions, who was bullish on OPTX. And when the short report came out, this very poorly written report, it was enough to make Billy Billions no longer be bullish on OPTX, which tells me that what I already knew from seeing his research, he's another one of the 10,000 clowns. Because if you can read a poorly written short report and get scared out of your long, then you don't know how to do research. Billy Billions clearly does not know how to do what I consider to be professional research. Right? Not saying OPTX is the greatest thing and Billy Billions is dumb and it's going to $60. No. I'm just solely focused on the concept that you would take a poorly written report and then reach out to your thousands of followers and say, I'm waving the white flag because this guy made some good points. No, dummy, you should understand all the points ahead of time. And then when they come up, be able to identify whether there are new points that are valid or if it's just fluff. So both were true, actually. We had a short report that was fluff, and we had a Billy Billions, right? We had a bear that was garbage, and we had a bull that was garbage. And the net effect, people shoot first and ask questions later. The stock broke out of its uptrend and is now actually trying to regain it, as you can see here, starting to move back constructively as we had a capitulation in the stock, people piling out, and then other people, right? People like me, I actually used this opportunity to increase my position. I was waiting. When I see people panic, I'm like, let them panic. Let them panic. I'm not going to go live and tell people that they shouldn't be panicking. That's not my responsibility. I'm here to educate people on how to not make those kinds of mistakes. And if they still want to make those mistakes, well, guess what? I'm going to be there to pick up the pieces. So, boom, right? Stock pulls back, and now you see it firming up. Why? Because there are people out there, in my opinion, this is a pure opinion comment, there are people who believe that this stock is worth significantly more than where it is right now, that believe the initial thesis given by Rob Mock and are buying the stock. I'm not going to make any statement as to whether or not, what I think the stock is worth or what I think of Rob's research. Well, I said I like Rob's research. You can go check that out. In terms of what you should do with the stock, you can go ask Rob, right? Or make the decision for yourself. I'm not here to give you stock advice. So that's OPTX. And then we had TPCS. They announced earnings. And unfortunately, they have lumpy earnings. Sometimes it's lumpy good. Sometimes it's lumpy bad. This time it was lumpy bad, right? And what we have as a result is a stock that is now trading close to my green line. There we go. Let's pull this back. And you can see what we're dealing with here. Okay. I can tell you from the people that I've spoken to with regard to what happened in the quarter that we should not expect that to happen again in the current quarter. Management has said as much. Okay. And the bottom line here is the company continues to show some erratic internal execution, which is being addressed by the new board members that were put in place a little over a year ago, the activists, okay? In my opinion, the CEO, Alex Chen, sorry, Alex, you're a good guy and all, but you're just not a good CEO. I have a sense that you are now on the hot seat to be replaced with somebody who actually knows how to negotiate contracts with the contractors to make sure that you have assurances with regard to delays and pricing and things like that. Yes, you have been making progress in that regard, but clearly it's not enough if your bad quarter should still be a profitable one, okay? Especially in this environment where you see the macro news continues to be positive. And my view of TPCS continues to be positive. Why? Because if you look at what's happening in the industry in which they work, they're a subcontractor, they provide parts, they are the only company that makes the parts they make that go into these submarines, helicopters, and jet fighters. Okay, the parts that they make, 91% of their revenue, they have a monopoly on those parts. Last time I checked, monopolies are supposed to be profitable, and wildly so, especially in an industry that is showing positive macro trends. And most recently, this is the latest news, positive news, the submarine program. Okay, you see the Accountability Office report found the submarine was 12% behind schedule due to material availability issues. Now, That's what it was. And the government came down hard on the general contractors. And you saw I've been reporting, Electric Boat buying Macy's and an entire mall to expand their capacity. The government giving out free money to make sure that these parts are available and employees are paid so they can make these subs and stop falling behind schedule. Well, by the way, TPCS just got another $3 million of free money from the government, okay, to buy equipment. Well, that's interesting because they are not running at full capacity right now, okay? I believe full capacity to be somewhere in the order of 12 to 15 million per quarter. They're not close to that right now. And yet the government gave them money to buy more equipment. What does that tell you? Common sense. That's a common, I don't even have to give you the answer to that question, right? And also, because of the pressure the government has put on Electric Boat and others, the program is planning to reach full rate production in 2031. And last year, they were being built at an average of 0.4 boats per year, twice double the 2024 rate. As a result, I had to go into my model and change this number, update it to a higher number, not 0.2, but 0.4, because this says 0.4. And full rate production in 2031, so I had to go to 2030. I didn't even go out to 2031 in this model. I only go to 2030 and get them close, 0.8, to full rate production. If I go out to 2031, 2032, then this goes from 0.8 to 0.9 to 1.0 full rate production. Okay? And what that did was it upped my model of what I think TPCS can do if and when they are operating on all cylinders, and it's pretty close to $1 of EPS, followed by $1.50, followed by $2, and the stock currently being at 4. Okay, so very reflective. It makes sense. It validates my red-green lines where when the company does bad, people sell off, they get depressed. Well, now the stock isn't pricing in very much execution at all. It's basically a 0 on the 0 to 10 scale, right? And if a stock is here and operating at more than 0 cylinders, then it should be a higher price. If this stock was if this company was operating on 10 cylinders, and it's not, and it won't be tomorrow, right? Maybe it takes a year, maybe it takes 2 years, but if they approach operating on all 10 cylinders, this is where the stock will probably or should trade. I can't say probably, gotta be careful. Should trade based on my personal analysis. You do your own. Okay, and if that happens, then boom, you're dealing with a stock that can grow 100% a year if we assume that this is where it's going over this time frame. This is how I make my money, by piling into stocks, increasing my exposure, or creating my exposure to stocks at levels that reflect no execution, where you actually see proof of execution. To some extent, TPCS has no choice in this matter. They're the only company that makes the parts. So as this production increases, they're going to get more orders. They don't have salespeople that go out and ask the submarine people to buy more of their parts. No. They're like, what are you doing here? Go back to your factory. We'll call you when we're ready for the next part that we need for our next submarine. And the number of submarines they're producing is now 2x what it was in 2024. It's simple. It's as simple as that, okay? From there, it's just a matter of company execution. Okay, final thing before we go into Q&A. We're on a good schedule here. Ring Central, look at this. My. For a company that was probably getting hit along with other software companies, right? We can zoom in on this chart. This thing is now up 36% today. Why? Well, let's zoom in on the chart. You can see this performance drop off. You can see it was doing very bad alongside other companies involved, it's software, communications, things like that. And then, well, why would it be going up if AI is going to destroy all these guys? Well, they announced great earnings. Not only did they announce great earnings, they announced the buyback. Not only did they do that, but they announced that AI is very much helping their business. Well, that should come as no surprise to anybody because as I said the last time we spoke, AI, if you have AI agents, they're going to go and do work for you. They're going to make phone calls, create communications between them and other entities, things of that nature. And the most likely, they're not going to use cell phones. They're going to use services like this. Not only that, but Crescendo, one of my names, I don't own Ring Central. I wish I did today, but I do own Crescendo, and I've been a happy shareholder for the most part over the last few years as the stock has done very well. But then you see the stock has gotten smoked alongside all the other shoot first, ask questions later AI casualties, right? Because people don't know what's going to happen to these guys. Well, unfortunately, I was playing phone tag with the president of Crescendo, but he did send me a note, and he said, "Yes, we support agentic AI on our platform, and will have more variants soon." And he mentioned Cairo, which is their AI receptionist, right? This stuff is not easy. This is infrastructure, okay? This is not pure software. I've been looking into this, and I wanted to talk to him about it so I could talk more intelligently about it on this show. But they have infrastructure that is not easy to build. Regulations that they need to follow that is not easy to follow. It's not something that AI can do. Okay, so when you have a moat, when you have a barrier to entry into your industry, AI is almost inevitably, assuredly going to be positive for you. Because the positives are, of course, right, the efficiency. Crescendo can create AI products. They can make more of their software more cheaply because AI can make software now. Right? That's all positive, but then you say, well, so can everybody else and they can become competitors. Well, that's where the barriers to entry come in. And because Crescendo has barriers to entry, they get to benefit from AI without worrying about as much about the negatives, the downsides of AI, that being other competitors coming into their space. Now, does that mean that there's no way a new competitor can come in? No. But it does mean that there's a high probability that the benefits are going to outweigh the negatives. And Ring Central is a perfect example of that, showing today, changing Wall Street's mind about who benefits from this. Now, what I wonder is, I wonder if 8x8, let me see. Let me see, 8x8, come on. All right, here we go. Up 4%. Okay, this was gotten smoked as well, but then you see, boom, there's this jump up here. Boom, right? These companies have a barrier to entry, and people are starting to realize, oh, maybe it wasn't such a good idea to sell it at 2 and 190 and 180 and 170 and even 160. And next thing you know, it bounces right back above 230 now. If you were a believer, you just made yourself a quick 40% in 20 days. If you were a believer in Ring Central, you're making 35% today, and off of the lows, we're up 60% in 18 days. Okay? These are some well-known names on Wall Street, by the way. So these are the names that are going to catch attention. I'm kind of curious. Twilio also up marginally. Twilio should be taken up in this as well. And certainly CXDO, but CXDO, not a well-known name on Wall Street. Why? Well, the companies that I talk about don't tend to be the Wall Street names, right? I don't want to compete with all of those Harvard MBAs. I want to compete against the dummies out there. I want to be looking for stocks that Wall Street isn't paying attention to, because that's where you're going to find the best bargains, right? So boom, here we have CXDO today. I think on the Ring Central news, I think that's a positive. I think the text that I got from the president of CXDO, positive. All right. Let's go to Q&A. See what y'all want to talk about today. By the way, I'm just going to skip over dumb questions. If you did not put a question mark at the beginning of your question, I will skip it. If I don't like the question, I will skip it. Okay? We're going to save time here for everybody. If you made your question and it doesn't have a question mark, put it back in the queue with a question mark in front of it. Okay? Let's see what we got here. And I'm not even going to read the questions out loud as I usually do, because if it's dumb and I'm going to skip it, I'm just going to skip it. Somebody asked why I don't use 2x or 3x instruments. I've asked her that question a million times. I don't like leveraged instruments. Don't use it. It's risky. What do I think about the Supreme Court's decision to revoke tariffs and what impact it will have on the market? I don't know. That's past my pay grade. When you talk about the impact of something big on something big, like a Supreme Court decision on the whole stock market, you're getting past my pay grade and you're probably getting into God's pay grade. Okay? Because it's just so complex to figure. There's like a million moving parts there. When you deal with a company like CXDO or any of the other names that we've talked about in the past, any of my winners in the past, KNF, just to name some, right? At random. These are small companies that do simple things that is easy to understand. TPCS does a simple thing, easy to understand, and know that it is riding the coattails of a big growing trend, right? Kraken, batteries for autonomous submersive vehicles, right? And we all know autonomous subs is a big thing. And if the batteries are going to be from Kraken, then Kraken's going up, and boom, bought it at 60 cents, sold it after a triple, and then it tripled again after I sold it. So the stock is up 9 or 10x from when I first purchased it. It's easy because it's an easy company. They make batteries. Batteries are hot. Right? You do the valuation analysis, and that's the important thing, because it's not as simple as just buying a battery company because batteries are needed for subs. You need to ascertain. This is the hard part. Right? And this is where independent, third-party, industry experts are critical. And I know it's not easy to find, but that's what makes millionaires. That's the difference. Because one battery company can be a complete POS and the other one can be Kraken. I had independent third-party industry experts validating Kraken as the cream of the crop. And the second part that's important, not just getting the experts to validate the technology and the positioning of the company, but then you have to validate the valuation of the company. Is it cheap or expensive? And at this time, I determined this was very cheap. I thought operating on all cylinders, the stock should be worth at least 2. I assumed that it would be operating on all cylinders at some point because of the major demand and the fact that these guys are the Cadillac, not just very good or excellent, but the Cadillac. And it happened really fast. And in fact, it just kept going from there. Left me behind. That's cool. Right? Because at this point, I didn't have the expertise. I didn't have enough knowledge to feel comfortable saying this stock should be worth more. I was only comfortable here, so I take my triple and I move on. Oh, poor Mark. Oh, all right, let's keep going. So yeah, in short, with these big things, it's hard to make, like, you don't even worry about this stuff. Really, honestly, if you are buying a company, and this is my goal, right? My goal is to buy a company that I think is currently worth 10, that I think will be worth 20, let's say in 2 years. I'm going to double my money in 2 years on this stock if I pay the fair price today, 10. But then I take it a step further and I say, I don't want to pay the fair price today. Yes, I know it's going to double, but I want a discount on that 10 anyways. I want that stock to not be at 10. I want it at 5. I want to buy a stock for $5 that I think is worth 10 today, that I think is going to be worth 20 in the future. That way, if I'm right, I have a 4-bagger in 2 years. And if I'm wrong in any way, shape, or form, there's still many ways for me to win. If I'm wrong about it being worth 10 and it's only worth 5, but it still doubles in 2 years, then my $5 goes to $10. If I pay the full $10 and I'm wrong about the $10, then 2 years later the stock is still at $10, I made nothing. But if I paid a discount, if I paid 5, I double my money. So you get the two major things working in your favor. The future is bright and the present is discounted heavily. That's what I present. All right. And those companies are easier than to say the stock market, because the stock market is never going to be 50% discounted relative to a future where it doubles in 2 years. Simple. I'm sure that's easy to understand, hopefully. Okay. Have I tried using Claude Code? No, not yet, and I need to. I know people who have, and it's very good and getting better. Okay, and this is the thing. There's a lot of people saying, well, Claude Code's not that great. AI is not that great at making software. It's pretty good. Okay, cool. I'll let you have that. It's only pretty good. But 2 years ago, it wasn't capable at all. Okay, and so, when I was a runner and I went from running 90 seconds for my first 400 meter to running 59 seconds when I was a freshman in high school, to running 50 seconds when I was a senior in high school, college coaches looked and said, well, his trajectory is good. He'll probably be running in the 40s if I give him a scholarship. Right? This is what people aren't looking at. People are looking at what AI is doing today instead of looking at what the trajectory is. And the trajectory is crazy. Okay? Because we went from asking ChatGPT why the sky is blue 2 years ago to AI is making Morgan Stanley stock go down, to AI is making full fight scenes with Brad Pitt and Tom Cruise, to AI is making software so good that it's making stocks like Salesforce.com and ServiceNow get crushed. That is a crazy trajectory for 2 or 3 years from zero to now. Look at the trajectory. Alstom chart, you can look that up yourself. Do you think Disney is a contender of the next stock to get whacked with the democratization of high quality content creation? I think it already has been getting hurt. People are already looking at that, right? Obviously, we just talked about it, right? I talked about, there's a problem here, right? Piracy was an issue before. Pirating the Avengers movie and letting people watch it for free in certain countries or on certain platforms, that's, piracy. But what happens if somebody actually makes a whole movie with the characters that you own? That's a problem, right? I'm sure Disney will figure out how to work it out. Because the United States of America has certainly come to the defense. There's no way that the United States of America is going to let Hollywood completely go down the tubes because there are some bad actors around the world willing to make Avengers movies using AI. Okay? They'll negotiate with these countries and say, if you don't crack down on this, right? Like fentanyl, remember that? You guys, all the fentanyl is coming from your country. You're not doing enough to stop fentanyl from coming into our country and being produced in your country. We're going to put sanctions on you. We're not going to do business with you. We're going to do things that are going to make your economy go down the tubes unless you stop this deadly drug from coming into our country. And the same thing will play out for that. So that's how I think that's going to play out, right? Why do I think TPCS backlog hasn't changed at all year over year? Because it goes up and down. And by the way, I wouldn't be surprised if it doesn't change at all for the next several years, because the backlog, like these, their customers don't have to give them years of advance notice necessarily. They might give them advance notice of years, but there's only a certain amount of advance notice that they need to be given, because what's funny is not only is TPCS the only place that they can get these parts, but those customers are the only customers for those parts. There's only one company that makes F-15EX fighters. There's only one company that makes CH-53K helicopters. So they all know each other. Okay? They all know each other. All right. So I wouldn't worry about the backlog there. I'm more concerned with, I want to see the macro continue to move in a positive direction, and it is. I want to feel good that they're in a defensive sector. They are. And I want to see more progress on getting Stadco to be operating on 10 cylinders, which they've been making progress, but it's not enough. And now we see there's going to be, I think, some more activism there to make sure that it happens. I mean, really all it takes is a phone call from the general who's now on the board of directors to the major or the colonel who is in charge of the F-15EX program or the CH-53K program and say, hey, listen, this is General, I forget his name, right? A colonel will take that call and they will have a conversation, and the colonel is going to understand and respect what the general has to say, and he's going to filter it down to his subordinates and say, hey, general contractor, you guys are posing a risk to this program that I'm in charge of. Fix it now, right? It's not as simple as that, but I think that's we're gonna see some more action here because they've made some progress, but it's not enough. We saw, the quarters go from 7 to 7.5 to 7, and then now it's 9, and then it drops down. When a drop down, it's to 7. I want to see it move up so that the drop down is to 10, and the good quarter is 15, and the bad quarter is 10, and it's profitable no matter what. Progress, right? That's sometimes what happens. Look, if the company was operating on all cylinders, it wouldn't be trading at this price. Therein lies the opportunity, is understanding the situation and the probabilistic number of scenarios that something works out in your favor. Simple as that. For BCHT, management said they expect the legacy air business to hit a $40 million run rate by the end of 2026, effectively doubling trailing 12-month revenue. Is this driven by license revenue? Yeah, of course. I mean, the air business, what they do is they help to clean the air that comes out of coal plants. Right, coal is very dirty, and you need there are environmental controls out there, and those environmental controls force these coal-fired plants to have a certain amount of cleanliness of the air that comes out of those factories, right? And Birch Tech is making 8 figures per year supplying technology that enables that, okay? Now that they have gotten some good litigation in their favor, that's only going to push that forward. Also, think about this, right? We have, it's funny because you got EVs, right? People, well, EVs are much better because they use electricity. Well, where do you think the electricity comes from? A coal plant. So when you plug in your electric vehicle, you're actually probably causing a coal plant to also increase its production, which increases the pollution that it dishes out. Now, here's where the good news is. The difference is from a gas-oriented car, right? The pollution comes out of the car. Each single car out there dishes out its own pollution. But when you plug in an electric vehicle, there's probably only one coal plant that is feeding that specific line. Right? And that one coal plant is under the purview of those regulations to cut down on the pollution it creates so it can take care of that all at once. Right? So what we should see with AI and electric vehicles is, and we're obviously seeing it, is a continued increase in the production of electricity in our society. And coal is a part of that. Not going away anytime soon. We have to wait several more years for nuclear to kick in, and I want that. I'm not in favor of coal plants, but I am not also in favor of stalling production of society. Let's fix the problem where it lies. If coal plants produce a lot of pollution, well, make the coal plants not produce a lot of pollution, until we can get the nuclear up and running. And I think that's exactly what's happening. All right. And if you have a different political view, I respect it. I'm not a, pro or anti-Trump, blah, blah, blah. I sit more in the middle. I'm a very common sense oriented person. Let's keep going. CTLP, assuming that the deal closes by the end of June, the annual return would be 26%. Cash mergers typically trade at lower returns, blah, blah, blah. The market is pricing in significant risk. Do you think those are justified? I mean, there are risks. The department, I talked about this months ago. So there's no change in my view. The risks are there, and the market is giving you a discount associated with that risk that either the deal takes longer to happen or falls through, and that's really what it comes down to. So the issue when it comes to, and we just talked about Birch Tech, and now we're talking about Cantaloupe. When it comes to court cases and judgments and awards and mergers and acquisitions and things like that, where it seems like, well, this should happen, right? Third-party independent expert analysis is also needed in those situations. And I'm not a lawyer. I'm not a patent expert and all these things. I'm not an M&A expert. I do the best of my ability to tell you what I think about a situation, but be careful, right? Because you have to know what you're getting into. Am I involved with Cantaloupe still? Yes, actually through CTLPP. I own CTLPP in pretty good size because I like the risk reward of that. But make no mistake, it's not a 100% bet. If it was a 100% bet, CTLPP would probably be trading at something like 61 instead of 52, whatever it is, 54 right now. Okay, the discount is there because of the risk, and you accept the risk or you don't. Once you do that, don't change your mind unless you're given good reason, and the stock moving in a certain direction is not a good reason. Usually, a stock moving against you, all else being equal, is a good reason to buy more, not to sell. All else being equal. If you have information that changes the calculus, fine. But a stock moving against you that you've decided to buy is more of a reason to buy more than to sell. Put that in your notebook. VKPRF chart. There you go. How do you tell if the short report for a stock is garbage? Bro, it just comes down to like learning. I've been doing this for 30 years. I was mentored for 10. I went to school for 5. CFA program, so really 6. To master the art of knowing what's important and what's not, right? When I tell you PE is BS, that's because I know that PE is BS. It's a simple, lazy measure that people use. And I will use PE as well because it's a simple, lazy measure. But it's ultimately BS, okay? For many reasons. The gold standard of the value of a company is DCF, not PE. You have to understand all of these concepts. And I know, like, I can't, right? You cannot be expected. This is not your job. Your job is where you are right now, right? Or where you're going later, your 9 to 5, so to speak, right? But unfortunately, if you want to make money at your job and you want to make money on stocks, you have to treat both like a job. To make millions on stocks is a job. And part of that job is learning how to do that job well. And that's part of what I just described to you. You speak of nibbling on great stocks on their way down. Can you give further insights on deploying our cash on the way down? I mean, it's risk reward, right? Like we've talked. That's what this whole show is about. This is a 0. This is a 0. This is a 10 in terms of attractiveness, right? If you believe in this company, then this price is a 10. I backed up the truck here, right? I lightened up the truck here. I do, and that's, and obviously here and here, these spikes, right? It's easy. If you can determine that a stock is good to buy, then you just need to determine the right price. So with Amazon, I know I have lines for that one, right? These are my personal lines, right? Not making a statement or telling you that you should be buying or selling the stock at these levels, and just waiting for the chart to catch up to my actions here. Come on now. Hopefully it will in a sec. There we go. Boom. And boom. There's my chart on Amazon. We'll get rid of those lines at some point. And there we stand, right? There's Amazon as it stands on my chart in between the risk reward lines. That sounds like looks like it's pretty much in the middle. And this is why I'm predisposed to buying Amazon. Haven't made the decision yet, but I'm looking at it. I'm like, man, I think Amazon is in really good shape here, but it's trading in the middle of my personal range. Now, I might have to change the personal range and all that because it has a CAGR of 17. That means an expectation of 17% earnings growth. For a company this big that's probably aggressive, it probably have to flatten this out more, right? So keep that in mind. But these are my charts, so that's for me to do before I make my decision on whether to buy Amazon. But as it stands right now, if you look at this looks really attractive because it's down here. NVIDIA, I'm not nibbling on NVIDIA on a pullback from, let's zoom in, from 212 to 170 because it's still really close to the red line. So even though this move here was a 19% drop in the stock, that's not enough for me because there's my green line. We're all the way up here at the zero attractiveness line. Nowhere near the 10 attractiveness line, which is, if we go back, where it was at some point in time. Right? Look at that. So there we go. Right? Back in 2023. Right? And this is also an attractiveness line. Right here. Right? So secondary attractiveness were at these levels, and I was definitely positive on this stock at these levels. Will it be difficult to get rid of the CEO of TPCS if he's on the hot seat? I don't think so, to be honest. Okay, look, I think he's a good operator. I think he can manage a plant very well. He could be a chief operating officer. I've said for a while, despite the fact that I think he's a nice guy, I don't think he's cut out to be the CEO. And it's not my choice. It is the choice of the powers that be at that organization, on the board of directors, and etc. And if they reach a breaking point where they decide, you know what, we've given you every opportunity, and that's what they need to do. Give him every opportunity to succeed. And if they find that his performance is not adequate to the job, then they're going to give that job to somebody else. Simple as that. No, it's not that difficult. How do I think AI will affect IDN? That's a good question, my friend, and it's a hard question to answer. Okay, that is a tricky question. But one thing for sure, hindsight being 2020, we can now say that Money Mark was right to get rid of his stock at 667, I think it was what I said, because the stock is now down 27% since then, because of simple common sense. Because when we bought the stock, it had a nice run, and then it had this sharp move. More importantly, right? So you had an opportunity to take some profits, right, if you were in early here. But more importantly, this move right here was like a 60% move on their earnings report. And it was a great earnings report. But every great earnings report deserves a different spike in the stock. Sometimes 1%, sometimes 5%, sometimes 10%, sometimes 30%, sometimes 60%, like this, right? This wasn't one of those cases. The stock was up 60%, yes. On the earnings news, yes. But in my opinion, as I looked at the earnings, I was like, these are great earnings, but they're not worth a 60% stock spike in the stock price, okay? And so I thought that there was probably a better chance than not. Oftentimes, what you're going to see is when you see a gap up, you see that gap, there was nothing happened. Like, see, stock's moving like this, and there's no gap. And then you see this big gap. If the gap that gets created is created by something that is not warranted, earned, deserved. Great earnings, sure, but not great enough to justify a 24% gap up. The gap usually fills. In other words, the stock usually pulls back to the original level and then recalculates what happens next. The market will kind of, okay, well, we're back to where we were, and that's what it did. It came back to where it was before the earnings announcement. Look at that line, right? And now the market said, well, now it's trading at the same price as it was before they announced those great earnings, and you're starting to see it get a little bit of strength here, right? And so that's, now the market has to figure out, because it's been a long time since then, right? Back when we picked the stock originally, AI wasn't so much of a considered, oh, is it a threat or is it a help? And it's really, I've been trying to figure that out with IDN, but I've been out of the stock, obviously, as I told everybody back at 667, and I've had a lot going on, too much to try to sit down and spend the hours necessary to ascertain whether I should get back in here at 488. So I don't know is the answer in this case, sorry. But hopefully we'll figure it out. Okay, there's no more questions in the queue. So there you go. Can't guarantee I'll be here next week. This is no longer a weekly show. This is a when Money Mark wants to do it type of show. Okay, so keep that in mind. I think it's a good decision for me. I know maybe it's not a good decision for you guys. It changes nothing though about the methods that I teach. If I get hit by a bus and die tomorrow, God forbid, everything that I have taught on this show will be valid. Everything in your notebook from learning my lessons will still be valid. Okay, so if you see stocks that have pulled back and every week you want to hear me validate and give you reassurance and all of that, well, then you're not doing your part of learning, okay? Because you don't need me for that. And in fact, right, as I've said many times, we are competitors for great deals, right? When I find a stock that I want to get into, there's a good chance, especially with these small companies and my net worth, that I can move a stock just by my buying, right? If I want $1 million worth of IDN, the stock will probably not stay at 489. If I could buy $1 million worth of IDN at 489 and I wanted to buy it, then I could just put a market order. But if I put a market order for 1 million shares at 489 right now, the stock's going up, guaranteed. Okay, so what that means is that you guys have to be able to make some of your own determinations instead of waiting for me to come on and say, I liked this price, so I bought it. And then you say, well, if Mark did it, then I'm going to do it too, which is your choice, not mine. Right? You can preempt that from all the teachings. I've armed you to actually be better than me at what I do. All you need to do that is follow the rules better than I do. And trust me, I only give myself a B plus or an A minus when it comes to following the rules, because we're all human. The hardest part about following the rules are just there on paper. That's easy. Here are the rules. Just follow them. Sounds easy, but as a human being, it's hard when you're seeing a stock going down to put your balls on the table and say, the rules say buy more, I'm going to go buy more, right? And not just because it moved down a little bit, but because you're looking at the whole chart and you're saying there's been a significant move, right? And you see here, look, as much as the stock has come down from, what is that, a 35% from the top to the current price, that's a 35% move. That sounds substantial, but look at it in the context of the whole risk reward chart. It's only that small. That's decent. That's a decent chunk of movement in the risk reward chart. But that looks like what? Maybe a quarter of the whole chart, right? We can put one of these boxes, duplicate it, put another one up here, duplicate it, another one here, duplicate it. Let's see how many of these boxes we can fit in the whole risk reward chart. More than 4. Almost 5. That means that this move right here is only about it's only 20% of the whole move. It's 2 points, right? On a scale of 1 to 10, 1 to 10 of attractiveness, it's only moved 2, maybe 2.5 at most. So, it might seem like a lot. Oh, geez, it's down 36%, but it's only down really 2 points on my risk reward charts. So you got to keep things in perspective as well in terms of deciding when you want to make a move on something. Not saying you don't want to buy the stock here, because if you don't own any and you like it down here, because frankly, look, we're much closer to the 10 than we are to the 0, and you like the stock, that's your choice, and you don't own any. Look, if I didn't own any and I like the stock, I'm buying here. It's as simple as that, right? So there you go. Let's see if there's any other questions. I don't understand this question. So, leading surgeons, some of the best companies getting smoked with AI. I mean, I don't know. Oh, I get it. They're saying, because the AI companies, do you think it's plausible that AI apps will eventually get very expensive so that many companies vulnerable to their competition go out of business and AI providers try to recoup their enormous investments, leading to a resurgence of some of the best companies now getting smoked? Look, your ability to recoup an investment is not up to you. It's up to the market. It's up to the competition. I almost guarantee you that some of the big names in AI right now are going to have lower valuations at some point in the future, fail to some degree, and maybe get acquired by Apple or somebody like that who hasn't greatly participated in AI to this point. So that's one thing. The other thing is, right now there's a lot of software developers that are not putting in a big investment to develop software. The development of software is very, very cheap right now, utilizing AI infrastructure. It's not OpenAI that's developing software with AI. I mean, they are, but it's customers, specifically Anthropic, mostly Anthropic. Anthropic's the big gun here, that people are using Anthropic's AI capabilities to write software. And they're spending a fraction of what it would cost before Anthropic to develop that software. So there's not a major investment. In fact, it's a much smaller investment than it ever was. So really what you have to look at is say to yourself, okay, this company that I'm looking at. Now, I'll tell you this. If you have a small software company who competes with large software companies in the same space that are more significant and better at what they do. That's not Crescendo, by the way. Crescendo is better than the large companies. Crescendo, by all accounts, is the best at what they do. Okay? But if Crescendo was considered to be a middle-of-the-road vendor, they got a middle-of-the-road product. They're a middle of the road in terms of where they're positioned against the competition. You want nothing to do with that, because AI is only going to make it worse. So there's a lot of small software companies out there that I am sure, right? And let me see. I was going to see if there was just an easy way to find companies with soft at the end of their name, right? Or software, Meridian Software, Millennium Software. Just taking them at random. If you haven't heard of these companies, right? That didn't bring up anything. You're probably going to find companies that have gotten smoked. Assure Software. This is actually, I think this is a pretty good example, because it's been a while, but this is a company that kind of struck me as, this isn't a company that does anything particularly special. They just do a good job of making software and having salespeople go out and sell it. Right? And you see, like, the stock hasn't gone much of anywhere over the years. But now with AI, it's very easy for somebody to come in and build what they built, because it's not great, complex software that they sell, and sell it more cheaply than they do and make some inroads really quick and easily at very low risk, because it didn't cost them much to make the software. The barriers to entry to a company like this has dropped. And so the stock dropping, to me, will be justified. Now, be careful, because I told you I haven't caught up on Assure in a long time, but I think this is a good example to provide, right? I'd have to do my research to see if they haven't done anything to give themselves barriers to entry, etc. But based on the last time I checked on these guys, I don't see anything special about these guys. They're not the best, right? Or have from the last time I checked, particular barriers to entry. So that's the way you got to look at these things. So, all right, that's about it. 90 minutes. I'm really happy that we were able to, after 2 weeks, I can get, instead of two 2-hour shows, one 90-minute show. Hopefully you guys are still getting value. I can see the number of people that attend the show, so that's great. Maybe I'll be back next week, maybe I won't. The only way you will know is if you hit the subscribe and notification button. But I will be back when it makes sense, right? To give you guys all that I can. All right, have a good weekend. Take care. Let's see what we got going on here.